Okay, so let's have a quick look at how to calculate both gross and net returns from a time series of data. These are monthly prices here, so when we calculate the gross returns, we're talking about gross monthly returns and simple monthly returns. I like calling them net returns as opposed to simple returns, just because it maybe makes it a bit clearer, but we'll call it simple because it's the way it's written there. So if we click in the cell here for gross returns, you can't see it at the moment, but if I show you this, it's the calculation to find the gross return. It says B4 on B3, so we take the price from the current period, which is this one here, 12.78, and divide by the price from the previous period. That's a gross return, a gross monthly return. So simple as. If there's an increase, it's going to be greater than 1. If there's a decrease in the price, obviously the gross return will be less than 1, like it was in the third period here, or the fourth time period, the third gross return that we have. Now to find the simple returns, or net returns, we just subtract 1 from the gross return. So 1.025 minus 1 gives us 2.57%. Okay, this column is obviously formatted for percentage. So that's it, gross and simple monthly returns. Couldn't be simpler. The next column here we have semi-annual gross return, which is exactly the same idea, except the way I do it is just by taking the value from that particular time period and dividing by the price 6 months ago. So we take 12.1 and divide by 12.46, and that'll give us the 6 monthly or semi-annual gross return, which here is 0.97. And if you've opened up this spreadsheet, you'll notice they've actually calculated this a different way. Let's have a little peek. They've multiplied lots of the gross returns together, and that's another way you can calculate this 6 monthly return. It's going to be the product of the last 6 returns, 1, 2, 3, 4, 5, 6. And that'll give you the semi-annual gross return. And the 6-month simple return is clearly going to be that minus 1. So here it's negative 2.89%. So we're quite used to seeing percentages in our financial data and reports and that kind of thing. So it's the simple or net returns that you're probably more used to seeing. So then we have the 1 year gross return, which is the same idea, except instead of dividing the current period by the previous one, we're dividing the current period by the price, which is a year ago. So that's fairly simple as well. So we've got the 1 year gross, 1 year simple, same idea, you're subtracting 1, or subtracting 1. 2 year gross, I'll have to scroll this up a little bit. 2 year gross is quite literally the final price that we have divided by the first price that we have, because we only have 2 years worth of data. And our annualized 2 year gross, if you have a click on that, it'll give us essentially the average yearly gross return within those 2 year period, that 2 year period. So the way we can get that is by taking the square root of the 2 year gross return, if that makes any sense. And here we have the net annualized gross return. So in essence, we're saying this particular stock has grown 13.42% on average every year. So I think that makes sense. Let's have a look now quickly at the continuously compounding returns. Now it's a very theoretical concept, the continuously compounding returns, because I'll just perhaps leave it there. You don't tend to get continuously compounding interest on all of your investments, and usually it's calculated at a daily rate or calculated at a monthly rate or something like that. But we can theoretically find these continuously compounding returns, and the way we do that is by taking, I'll see if I can scoot back over to the prices here. So we're going to take the log of the current price minus the log of the previous price. So that 2.54% was achieved by taking the log of 12.78 minus the log of 12.46. That'll give us the continuously compounded return for that particular period. And that can happen for every successive month. So that's the continuously compounded monthly return. And we're going to get the continuously compounded 6-monthly return as well, which by the same token is going to be the log of the current period, which would be the July 08, minus the log of the period 6 months ago, January 08. So simple enough. Log of one minus log of the other, that's how we find our continuously compounding returns. So that's it really for the Excel component of tutorial 1. So I'll move over now to talk about some MATLAB stuff.